Welcome back to the Mountain Morning Show. I'm joined by Travis McGhee from FuturesANIMal. What a great day to have you here, because we've had an interesting 2013. I think we can say that it's been a good one.
Yeah.
And welcome to the show, my friend.
Well, I'm glad to be here, and Happy New Year.
Happy New Year to you.
Last day of the year, so it's, I guess it's kind of exciting.
I think so.
Fresh, clean slate tomorrow.
Exactly.
Right?
I always think, though, you know, and I'm an optimist. It's always going to be better. Every year is better.
Yeah.
And I think that we can argue that for the most part, you know, traditionally over a longer period of time, which is what we really need to think about when we're talking finance, is that's true.
Yeah. You know,
we have down years.
We definitely have down years. Who knows what this next year is going to bring? We've had a heck of a run this year.
Yeah.
You know, depending on where the S&P 500 closes at the end of trading today, you know, we could be creeping up close to 30% on the year.
On stocks.
Yeah.
Is an amazing number.
on
but
stocks.
on the broader
so
market
we
as
haven't
well.
we haven't seen that, you know, returns like that since the late 90s. I think 1997's the last time we saw returns like that. So heading into 2014, you know, we have a lot of work ahead of us to replicate what we did this year. You know, is it possible? Sure, it's always possible, but you know, it's really hard to say looking into the future what the stock market's going to do, because there's a lot of stuff that pops up in between that's unforeseen, geopolitical stuff.
Sure.
You know, congressional stuff. You know,
Always.
we've got that whole debate coming up again here in February. So, you know, it's hard to say. But looking at a bigger picture, you know, you're looking at the fundamentals of the U.S. economy and seeing that improve.
It's real strong, which is good.
It feels good.
Yeah.
Yeah, we're seeing some strength come across. You know, corporate America's sitting on, as far as their balance sheets, are sitting on more cash than they've ever sat in. So they're in a very good position. So we're in a much better position than we were 5 years ago.
I'd love to see people start spending, you know,
Sure.
businesses especially, where they do have a lot of cash on hand. I think when that happens, the market's going to heat up pretty fast.
Right.
That's an exciting thing. Not to mention, as you said, I think as a whole, everything is pretty solid. So I think that you know, once that starts happening, it should be pretty tremendous.
So spending's that's a great point. Spending depends almost entirely on, you know, certainty. And when there's a lot of uncertainty in the market, which we've had for about 5 years, and a lot of that uncertainty boils around stuff like the debt ceiling.
Yeah, blame Congress.
Budget
I
debate.
would say, for sure.
It boils around the Federal Reserve and what are they going to do with interest rates. It boils around, you know, Iran and you know, Syria and stuff like that. So uncertainty is bad for markets, but it's also bad for the consumer. It's bad for businesses. Businesses don't want to spend. So you're exactly right. With more certainty, which it seems like we have a little more certainty, we have some more clarity on the Federal Reserve. We have a little bit of clarity on the budget moving forward. We're going to hopefully get some clarity on the debt ceiling. As things start to clear up and as people start to feel more comfortable with where we're going, I think that's going to bode extremely well for the market. So I do think we're going to have another decent year in the stock market. A 29+% year, I don't know. But I think we're still heading in the right direction.
Well, let's talk for a moment about some of the things that we can be proud of this year. So let's kind of go through them a little step by step. So we know, as we said, stocks very, very well. We know that was a great year. Let's talk about bonds.
Yeah. So yeah, recapping the market. Yeah, we talked about the broader market. Stocks did very well this year. Bonds, not so great.
Yeah.
You have a lot of folks right now, especially the older generation, who are primarily in fixed income instruments, opening up their statements and saying, what the heck happened? The stock market's at record gains and I'm losing money. Bonds really got turned upside down with having historically low interest rates like we did, and with the Federal Reserve wanting to start scaling back on their stimulus program. Interest rates shot through the roof.
Right.
So you saw that affect the bond market. You've seen that affect the mortgage rates, which could and has, to an extent, impacted some of the real estate market. So yeah, it's actually been a really historic year looking back.
Yeah, I'll
you know, particularly on the interest rate and the bond market side. We have not seen an interest rate move like that in quite some time. I mean, in May of this year, the 10-year, which is what pretty much everybody uses as a gauge
basis,
of
yeah.
long-term interest rates, was at 1.5%, 1.6%. In a little less than 2 months, it was at 3%. I mean, that's a big jump, which directly impacts other interest rates like mortgages.
Well, how did you feel about the timing of the bond buying announcement of curtailing that a little bit? That was I thought that was really well timed, I felt.
You know, it's hard to say with the timing.
It sure reacted the way we hoped, in the right direction.
There's never a good time.
Yeah.
There's never the perfect time to announce something like that. You just have to do it. And, you know, the Federal Reserve saw that the underlying fundamentals of the economy seemed to be picking up, so it was as good a time as any to say, hey, listen, I think we're going to start scaling this back. Now, the market's always going to react different. It's going to overreact. People are going to gripe. People are going to complain. People are going to say this isn't fair, yada, yada, yada. But bottom line, eventually, at some point in time, they have to stop the stimulus program. So, yeah, I think the timing was fine on that. So.
All right, well, let's talk about this. Every year I look at these ads for buying gold, buying silver, and I almost do it every time. He's like, oh, now's the time. You've got to buy gold and silver. And I think, you know, I don't have any in my portfolio. Maybe it's a good idea. It wasn't a good year to do it this year.
Looking at 2013, it was an absolute horrible year for precious metals. With precious metals, you have to understand the story, and you have to have a reason for buying it. And the story typically is that you're either one, fearful of inflation. Well, inflation's not there right now, so that didn't work out for you. Or you're fearful of just an ultimate collapse of you know, our fiat currency, just the general global market. You want something tangible to hold. So, you know, if anything, we've got an improving economy. We have no signs of inflation right now. So the story behind gold and to own it at where the prices were just wasn't there. So you've just seen mass liquidation of the precious metals. Especially since June, with Bernanke saying they're not going to print as much money as they were printing before.
Yeah, a much different situation than really any of the years previously. If we go back to 2007, 8, 9, this is a much different year.
And that's not to say you shouldn't own gold and silver. You just have to understand why, and that's what we've talked about a lot on this during this segment, is being educated. Understand why exactly you're holding it. If you're holding it as a long-term hedge against maybe your portfolio in case something, you know, really doom and gloom comes up forefront, you know, that's one thing. But if you're in there because your buddy told you you have to buy some gold because it's going to trade up to here, and you get caught up in this whole trading game with precious metals, you could get beaten up pretty bad.
All right, well, let's recap then and then talk about what we can expect next year. So we know, number one, we've got a Congress that's finally done something about a budget, so we have some relative certainty there. We've got, we've already changed the bond buying, so we know that there's not going to be any new real big announcements probably in that regard for a little bit of time. The interest rates will start to come up. The thing we obviously need to watch is how quickly, right?
Exactly.
And most leading economic indicators right now showing we're in the right direction. So as we look at next year, what are your thoughts, and what should we be, interest rates being one of them, what should we be looking for?
Yeah, so I think, again, I think equities are going to fare well heading into this year. So I think you continue to look at big, strong names, dividend-paying names, your GEs, some of your blue chips that pay nice dividends. I think you're going to continue to see some growth, and you know, there's some other individual sectors, you know, obviously you can get into and start looking at that could bode fairly well, that, you know, could be more or less of an interest rate play. But again, I think heading into 2014, it's still going to be a very interest rate driven market. Yes, we have some certainty out of the Federal Reserve, but this is still a very jittery market. And depending on how interest rates move, so the investor needs to look at that, especially those who are trading this market, how quickly interest rates move up or down could directly impact the stock market. So again, the big money, all the institutions are going to continue looking at the Federal Reserve heading into 2014, and that can be a big driver of the market moving forward.
If I understand it correctly, we're looking for something that looks more like an oven and less like a microwave,
Yeah.
right? When it comes to interest rates.
Exactly. You don't you don't want to see the jump that we saw in June,
Right.
from 1.6% to 3%, almost
Yeah.
doubling the yield in a couple of months. You want a nice, slow, consistent increase in the interest rates, supported by strong economic fundamentals.
Excellent. As we also look at the beginning of the year, I say it's high time to look at getting some education as we move into this next year. Everybody can use it. There's never a time when you know too much about investing. There's always something to learn.
There's always,
This would be a good time to look at that.
This, like I started the show off with, we start with a clean slate tomorrow. So regardless of how your portfolio performed this year, whether up or down, again, this is the time of the year to sit down as a family with your advisor, whoever, and reassess your finances and develop a plan heading into the next year.
All right. In case we don't get to see it clear until next year, how do we get in touch with you if we want some help to do that?
FuturesANIMal.com. We'll have the phone number there on the website. Give us a call. And again, we can help you with both of those fronts. The education front, if you're looking to get educated, or if you're looking for just some general wealth management, we're there too. So.
I have one last thing. How did our paper trade do?
That's a good question. I forgot. Yeah, so our paper trade did very well. So Joe and
we
I
made some money.
we had a demo account, and we made 8.2% in the 3 months that we traded.
Sure,
so
it should have been real.
That's
That's
like
awesome.
I said, we just wanted to hit a base hit.
Yep.
You know, so
And that's
3
what we did.
months, 8.2%. And we were outside of the stock market, believe it or not. So
Yeah.
you and I were doing some more alternative, different strategies to see what we could do in
That's
that
right.
market. And yeah, 8.2%, not too shabby.
Yeah, we were looking at base hits. We're not trying to be
Base hits.
We're not trying to be Big Poppy. We're trying to be Johnny Bench and Pete Rose.
Yeah, exactly.
Nice base hits. All right. Well, thanks as always for being here, Travis McGhee, FuturesANIMal.
Yep.
Good luck to you the next year
Thank
as
you, sir.
well.
You as well.
All right. When we come back, we'll be talking about the road to Sochi right after this.